There's a couple words I want you to put into your vocabulary. Leveraged loans. Back in 2007, 2008, nobody knew the word subprime crisis. Nobody knew the words credit default swap. Well, we're back to the same education. Leveraged loans are something that are going to appear more and more and more in the financial news because they are a problem. And they are the problem that is going to be with us for the next year and a half, maybe 2 years. I want to tell you a story so that you better understand leveraged loan. In 1984, a gentleman by the name of Guy Lavaliere from Canada started a street troupe entertainment called Circus du Soleil. You probably know Circus du Soleil. I first was introduced to Circus du Soleil in the Atlanta Braves parking lot in a circus tent. I would guess somewhere in the 2000s, I don't know. And I was blown away. I had never seen anything quite like that. I didn't like circuses. I do like Circus du Soleil. I then went and saw one in Orlando at Disney World. I've seen 2 of them in Las Vegas, which is the water one, and the Beatles. And my wife and I so wanted to see the Michael Jackson one, but we haven't made it out there yet. They have then opened venues on Broadway, in London, in Macau. They employ over 4,000 people. Well, over the years, Guy, the founder, started divesting and bringing in other investors. And he sold his last 10% of the company in February 2020. That was a timely sale. The investors at the same time expanded dramatically. That's how they got the venues in all those different cities. They also bought the Blue Man Group. They grew phenomenally. They borrowed a total of $900 million to finance this expansion. Well, why wouldn't they? The funds were coming through the door. They could charge virtually what they wanted for tickets because they had something so unique and so magnificent. They employed 4,000 people from 50 different countries. And then they had to shut down. Understand, they had then no cash flow. No cash flow to pay the debt that they had accumulated. $900 million in debt. Already, Moody's has rated them CR, which means they're in default, which means they will be filing bankruptcy, which means their creditors will buy their name for pennies on the dollar. I do not believe Circus du Soleil will go away. Somebody will buy the name and revitalize it, but pennies on the dollar. That's Circus du Soleil. It is estimated that in publicly traded companies, there are 1,450 Circus du Soleils. Companies who have over-leveraged themselves in leveraged debt. Now, what is leveraged debt? I always, when I was a financial advisor, we referred to it as junk bonds. I think junk bonds are even more leveraged than this. My point is, there's a lot of this leveraged debt out there. To give you some relative comparison, in the subprime crisis, which started in 2007, wasn't really recognized until July of 2008 when Lehman Brothers filed bankruptcy, and I'll show you in a second, the market didn't really react properly to that. At that point, in the subprime crisis, bad mortgages, there was $1.3 trillion worth of bad debt. To give you a relative comparison, within that 1,450 corporations that have this bad corporate leverage debt, there is 1.2 trillion. 1.3 subprime, 1.2 trillion leverage debt. Now, think about this. What is the effect of a person defaulting on their mortgage? They get thrown out of their house. Maybe they also, as a result of the whole real estate crisis, they lost their job. That's a rock thrown into a swimming pool. There are ripples. It affects people. Now think about Circus du Soleil filing bankruptcy. They have 4,000 employees. They have the venues that they were renting. They have the supplies that they received. That's like dropping a Mack truck into your backyard swimming pool. And as that truck hits the water, it also hits the pool wall and does substantial damage. The water comes out of the pool and floods your yard and goes into your family room. That's the effect of the ripple, the wave of $1.2 trillion worth of leveraged debt. Now, we are hearing that, is this going to be a V recovery or is it going to be a U recovery? How in the hell can it be a V recovery? How in the hell can you recover like this when that Mack truck hits the pool and floods your house? You aren't. There's damage done. There's structural damage done. It took us 4 years, I'll show you on the graph, 4 years to get back to where we were when Lehman Brothers crashed from the subprime crisis. I don't know how long it's going to take when this is over. The other thing I know is life is going to change. So let's go look at history, and maybe we can learn from history what a Mack truck being dropped into your swimming pool looks like. For some guidance on does the market get it right, let's take a look at what happened in 07 and 08. And again, I ask you to watch the movie The Big Short. We're looking here at roughly November of 07. And that's when the market first knew there were some problems with the subprime crisis. They really didn't respond to it until July of 08, and that was when Lehman Brothers failed. And that would be about right there. It's interesting that even as Lehman Brothers failed, the market actually went up a bit for just a short while. And then in September, what is that? July, August, September, 2 months, 60 days after Lehman failed, the market reacted. And from September 08 until March of 09, it went down. And so the full drop was roughly, over here we see it, 50%. We had roughly a 51% drop in the market. So my point is, the market doesn't always react in accordance with what is actually happening, and that's what I think is happening now. Now, the next thing to learn from this is how long does it take to recover? And I think, again, we need to remember that this involved $1.3 trillion worth of subprime debt, bad mortgages, bad loans made to people on homes that they could not meet their obligations. So we're now looking at roughly $1.2 trillion worth of bad loans, leveraged loans to corporations. And I think the ripple effect of corporations filing bankruptcy is far greater than that of a housing market crash. People are going to lose jobs. Other companies aren't going to receive money, and mutual funds and investors are going to lose money. So how long did it take from the trough of March 2009 to where it came back to the start of the dip? Roughly 2 years. 4 years. From 2009 to 13. That's how long it took the market to get back to where it was in 2007 or 2008 to 13. And it wasn't a straight line. So that gives you an idea of how astute the market is on assessing the potential damage of dropping a refrigerator into a swimming pool. Now I want to go over here and look at what happened after the market recovered. And we're going out to, let's see if we can get it to go out to, this is daily, let's put it on a weekly range or monthly, and we can see. This then takes us back to 2008, 10, when the recovery started. Now, we ask ourselves, how could these companies get themselves into such bad financial situation by expanding their factories, by Cirque du Soleil making all these new venues, by AMC theaters buying up other theaters, by car parts manufacturers building new plants to fill the demand from the Honda plant, from the Hyundai plant. Those are the Mercedes plants. Those are the three major manufacturers here of cars in Birmingham. How could they not see the potential disaster of getting themselves into these highly leveraged loans? Well, you're riding this wave, and your manufacturer or your audience is saying, we want more, we want more, we want more. And interest rates are down around 2%. Now, you can't get them at 2%, but you can get them at 6%, and the historical average is 8%. And so you go and you build a new plant, and you issue a bond, and it does come with a 6 or 8% interest rate, but things are good. And look, they just kept getting better. And we saw this 440% increase. That isn't fair. Let's go back to 2008. We saw this 360% increase in the stock, in the S&P. How could you not buy into things will be great forever? Donald Trump convinced us that he had the answer. He was bringing manufacturing back to the United States. He was going to make America proud again. And he did. But then something that nobody could have predicted happened. But it happened. And that's where we are now. And we keep hearing about the ripple effect. This is where we are now. This is not going to be a ripple effect. This is not houses. This is corporations. This is people losing their jobs. Be careful of REITs, real estate investment trusts. They are heavily leveraged. Think about over the last 5 years, 10 years, how your downtown has changed, how tremendous amounts of investment went into building office buildings and apartment buildings, and who lives in those office buildings and who has their offices in those office buildings. Some of the companies that are going to file bankruptcy are going to have offices in those office buildings. In those apartments are the people who work in the restaurants, in the hotel industry, in the entertainment industry. They aren't going to be able to pay their rent. So this is not going to be a V recovery. The market is, okay, this is the S&P today. We had a jobs report of 700,000 people lost their jobs. That is a record. And the S&P is down just a little over 0.5%. That's 700,000 people that aren't going to be working for probably the next 90 days at good. That's corporations that are going to file bankruptcy. We aren't reacting. As I said and showed you, the market did not assess the potential damage of the subprime crisis, which was $1.3 trillion of bad loans. They didn't and aren't assessing the damage of the $1.2 trillion of highly leveraged business loans. And the ripple, the wave from a corporation going down is far greater from somebody defaulting on a mortgage. That's simple to understand. So this is not going to be a V recovery. This is going to be a U recovery. I don't think it will take the 4 years that it took in the 2008 crisis, but it isn't going to happen in a matter of weeks like a lot of people believe. As you saw, the recovery was tremendous. I want you to understand what happened in that recovery that is unprecedented. Verizon bought Verizon Wireless for $130 billion. Dow Chemical bought DuPont for $130 billion. Anheuser-Busch bought InBev and Miller for $100 million. Heinz bought Kraft for $100 billion. AT&T bought Time Warner for $85.4 billion. Disney bought 21st Century Fox for $85 billion. CVS Drugs bought Aetna Insurance for $67.5 billion. I could go on. The point is, through more mergers and acquisitions, and these companies just making money hand over fist, they went into a lot of debt. The largest debt companies right now in the United States are AT&T, General Motors, General Electric, and these are companies who are also paying pensions. Now, what you also got to understand is when Cirque du Soleil took out this $900 million worth of debt, who bought it? Well, It was bought by mutual funds, and it was bought by pension programs, because pension funds have to have a predetermined mix of equities and bonds. Well, interest rates are down below 2%. So they can't make the 6 to 8% that they need to pay their obligations, so they bought this leveraged debt. Again, the Mack truck just hit the pool, and nobody knows it. Nobody's reacting to it. They're still having cocktails at the bar, in the family room. The wave hasn't hit the family room. This is what you need to understand as an investor. Now, if you're a trader, you're having a heyday. I mean, President Trump tweets that he's calling all the oil executives into the White House, and they're going to settle this Russian and Saudi Arabian oil problem, and oil prices go up 25%. Well, if you're a trader, you just made a killing. If you're a trader, you've got a bonanza in front of you. If you're a short seller, you've got a bonanza in front of you. If you're an investor, you need to be watching the numbers. I did some research on what people's quick ratio is, how they can, what companies' quick ratio is, how they can respond to short-term debt demands, what their debt to equity ratio is, what their margins of profit are, what their price to earnings are. If you're an investor right now, if you don't want to be in the market trading every day, but you want to buy companies that are going to survive this, and then, just like after the subprime crisis, ride that spike up, because there will be another spike up, because the medical industry is going to change dramatically. The way you live is going to change dramatically, and things are going to get a lot better than they were even before this virus came. The virus issue will never happen again. Our medical industry and our smart homes and our artificial intelligence and our smart bathrooms will make sure that never happens. It can't. It can't happen again. If we can't solve the problem through early diagnosis, we've got to shut our nation down and build a wall all our way around it. And that ain't going to happen. So, put the phrase leveraged debt into your vocabulary. Understand it. If you want the chart that I'm creating, go to bestofusadvisors.com and I'll send it to you. And I'm going to give you about 3 days to respond to this video, and I'll send it out Monday. So go register, and then everybody that's on it, if you have registered in the past, you will receive it. I'll work on it more this weekend and send it out Monday. But if you're an investor, you have to be investing defensively. Offensively investing is the price is low, I'm going to buy. Defensive investing is this company financially strong? Does it have a good business plan? Does it have good operating margins? And is this something I'd like to own for the rest of my life, and I'd like to leave to my children and my grandchildren? That's investing. Not saying it's down 65% and President Trump's going to give it a bump. That's trading. I'm not a trader.